our Director of Product and Sales Support. So I'm going to let Jake take over at this point.
Thanks, Greg. I'd like to thank everybody for taking the time to be on the call today. I want to share a sales idea with you today that I think will help you generate new sales that you may not have even considered in the past. So how many of you have clients that lost a lot of money in the stock market in 2008, 2009? Probably every one of you, right? And you can probably think of several of those clients that have moved wealth into stable, low-yielding investments like CDs and even money market accounts. And you might even have clients with a bunch of cash sitting in a checking account. So what's the problem with these low-risk investments? Low risk equals low return, right? So your client's money is not working for them, and often it's not even keeping pace with inflation. So they're actually losing money. 6 months of income typically is considered kind of an appropriate amount to have in liquid assets as an emergency fund. So we can agree that many of your clients probably have a lot more than this in liquid accounts, and subsequently, a lot of money is currently sitting on the sidelines, so to speak. This represents a huge opportunity for you as an insurance professional, and I want to show you today how you can turn these opportunities into life insurance sales. So getting into it, what's the concept? What are we talking about today? We're talking about repositioning low-yield money, earning a higher return on it. We want to retain that low risk. We want to retain liquidity, and we want to add extra benefits on top. We actually don't typically talk about specific products, but in this case, we have one product. It's a life insurance product that has a guaranteed surrender value that's greater than the initial deposit in year one. And that's what really makes this concept work for your clients. So what is our goal here? We want to have strong growth potential, right? We want to offer your clients something that gives them the potential for better growth than they're getting in something like a CD or a money market account. We want to retain that low risk profile because otherwise they probably, if they weren't risk averse, they probably would have already moved that money back into something in the stock market, some sort of mutual fund or something like that. And we'd also like to keep it liquid. What's one of the biggest objections you're going to get when asking somebody to put a large single premium into a life insurance contract? Well, where did all my money go? You know, if they don't have access to it, that's a big commitment for them to give that money to you. If they can retain that liquidity, that takes away a huge objection that normally you would have to fight. So those are our goals. What's the icing on the cake that we're giving our clients on top of all of that? We're giving them tax-deferred growth, right? The tax buildup inside a life insurance policy, the cash buildup is tax-deferred. It's not going to be tax-deferred in a CD or a money market account, right? You're going to get 1099 and you're going to pay tax on it. Immediate death benefit, 2 to 5 times your initial deposit. This is a life insurance contract. Depending on your age, you're going to have, if you're older, you'll have something like two times what you've put in. If you're younger, you'll have something closer to 5 times. So this is a self-completing plan, so to speak. If you die within a couple of years, well, your money has already doubled or tripled or whatever it is, and you don't have to worry about losing all that time for the money to grow. So it's self-completing with the death benefit. This plan includes a chronic illness rider to cover your client's long-term care needs. Okay, so if they're unable to perform 2 out of 6 ADLs or they have a severe cognitive impairment, they can access money to pay for that. It has a critical illness rider for major medical events. Say your client has a heart attack, is diagnosed with cancer, something like that. They can get payments out of the policy for that. So you can see we've added a lot of benefits. We've taken that money that's not even keeping up with inflation and has no other benefits with it besides being liquid, and we've given them all these extra benefits. So who would be the best people to approach with this plan? Who would be your prospects? The ideal prospect. There's a lot of people that fit into this category. Under age 75, typically, table 3 or better. And why did I say that? Well, I've seen it work best under age 75. We can do it up to 80, and sometimes it looks good. But typically, under age 75, and the reason I say table 3 or better is with this specific program, we have a table shave where we can shave 3 tables and go back to standard. Okay? So even if your client is older and has some impairments, we can still potentially get them to standard and really make this work for them. You probably want them to have at least 100K in low yield investments. This is just a general rule of thumb. If they're younger, and when I say younger, I'm including people even into your 50s, you could probably still use about 50K and still make this work. But 100,000 is really going to make it look good. The minimum face amount on this contract is 100, and so we need to make sure we get at least to that amount. But younger clients can use less. You want them to have a separate emergency fund. You know, maybe 6 months income would be a good recommendation for them. The reason I say this is while they have complete access to all their money in this contract from day one, you don't want them to take all of it out immediately because there is a chargeback schedule. There has to be, right? There's a 3-year chargeback, 100% in year 1, 75% for surrender in year 2, 25% in year 3. Now, that doesn't mean they can't take any money out. If you can let them take out up to 10% a year of their account value during the first 3 years, and you won't trigger any chargeback with that. We're talking about amounts in excess of that. So you want them to have a separate fund to pay for emergencies. Obviously, this is life insurance. They do need to have a need for life insurance to justify the underwriting, but thankfully that's most people, right? Don't forget about business owners. This is a great sale, a great concept for a business owner because a business owner may have cash they keep liquid to pay for certain equipment, whatever it is that they're going to do. They may keep a certain amount of money liquid to pay for that. And what's a big objection you're going to get from them about putting this into any sort of cash value policy? Well, if their surrender value, if the surrender charges are eating up all the surrender value, they can't keep that money on their balance sheet, right? However, if you have a product like this where their surrender value is immediately equal to what they put into it or more, then they can continue to carry that asset on their balance sheet. So that's going to take away a huge objection right there. So this is a great sale to approach business owners with. What's your competition when you're looking at this sort of thing? Okay, maybe treasury bonds. And for all of these investments, I looked at the best I could find. Okay, so this is very competitive rates right now. So you're looking at, you know, under 2% for any of these, even if you're tying your money up for 10 years, right? So you're not even keeping up with inflation there. CDs, 3-year, 5-year, you can see still under 3%, not good at all. Money market account, you're lucky to get 1%, okay? And so that's all of these scenarios I would consider as losing money scenarios. You're not even keeping up with inflation. So how do we make this work? What's our process? We're going to take a single premium, a lump sum of cash, and we're going to put it into an indexed universal life contract. We're going to use the minimum death benefit, and what does that do for us? That minimizes the cost of the insurance and maximizes the cash value that your client has access to, the cash value that can continue to grow for them. We're going to add a waiver of surrender charges rider, and that's important. That's what gives them immediate access to the money if they need it. Takes away all of the surrender charges. And we're going to include chronic and critical illness riders. These are included for free as part of this contract, a huge extra benefit. I'm going to talk briefly about the product. This is with North American. It's their Rapid Builder IUL. It has a 12.5% cap, 0% floor, 100% participation on their annual S&P point-to-point. Your client has a lot of options that you can show them, but this is just the one most people use. It's a very strong account. A 3% guaranteed minimum interest rate. I get a lot of questions about this one. Why do they have a 0% floor and a 3% guaranteed minimum interest rate? Well, what's happening is they're not saying that in any 1 year your client can't get 0. 0 is the worst they can do in any 1 year. What they are saying, though, is that over time, whenever your client either lapses the policy or surrenders it, or just every 8 years rolling, they will guarantee you that your client won't do any worse than 3% compounded, okay? So in any 1 year you could do 0, but over time or whenever you surrender it, they're going to make sure you haven't done any worse than 3%, or they'll true it up to that, okay? So obviously they're expecting you to do better than 3%, and with a 12.5% cap, you would certainly expect that you would. It has a nice persistency bonus in there. Pretty typical in the IUL market, but I like that this one is guaranteed. They have that waiver of surrender charges rider, which is important. They have a free chronic illness rider, a free critical illness rider, and here's an important point, 0% premium load. Most contracts have a premium load that just comes right off the top for usually the first 10 to 15 years, if not more, that really kind of hinders the initial cash growth in the policy. This one does not have any premium load. I mean, you can look up the expenses in the illustration, and it's just zeros. They don't have any of that premium load. Now, they have cost of insurance, but they don't have that premium load. So it's a very low-cost contract, the lowest that I've seen, and that really makes this thing work for your client. So let's look at a couple of examples here. Male age 50, $250,000 that he's going to put in as a single premium. What's going to happen? His initial death benefit is $720,000, so almost 3 times what he's put in, and his death benefit is increasing every year. His year 1 guaranteed surrender. This is the worst case scenario I want to bring out. This is the 3%, and this is also assuming that North American jacked up the cost of insurance to the maximum amount from day 1. That's not going to happen, but even if it did, worst case scenario, your client still hasn't lost money. They've gained a little bit. Let's say they did 7%, and the cost of insurance remained the same. This is pretty realistic with a 12.5% cap that in any one given year, your client might get 7%. They're up almost $15,000. This is the end of year 1. They're up $15,000 in this contract. In year 20, say they average 7% over that time, they have more than tripled their money. Let's say you're more conservative and you only did 5%. They have more than doubled their money, and they've had all these benefits at the same time. We can agree this would be a huge benefit over to them instead of having it in something like a CD. So this is just a graphical example here real quick. You can see kind of there's a big difference between 7 and 5, 5 and 3. But even worst case scenario, you can see your client is gaining money in this contract. They're not losing anything. So it's very solid performance, very stable investment. And like we said, it's liquid too. So one more example here, male 70, 250,000. So I'm just giving you an example of someone a little bit older here to see how it works. Their initial death benefit is $400,000, so a big bump over what they've put in. It's increasing every year. Year 1 guaranteed surrender value. Once you get into your 70s, there's a chance that worst case scenario, like I said, the cost of insurance goes up as well, that you have a small loss. So this is worst case scenario. A 70-year-old male paid, what is that, $1,500 for 1 year of insurance for $250,000. That's less than term insurance would have cost them, and that's the worst case scenario. Let's say they did 7%. They've got almost a $13,000 gain, a 70-year-old in this policy. Year 20, that's going to be pretty laid out for this guy, but he's got $670, and year 20 at 5%, he's had a $200,000 gain. Very solid performance. I wanted to show you what an illustration looks like so you can get into your head kind of what this is going to look like when you're looking over it. This is a female age 45. In this particular scenario, I'm showing a little bit less money going in to show what that looks like. This is $100,000, and you can see the death benefit is immediately 4 times what she put in, and it's growing every year. And also your cash value is doing very solidly, even 5%, 7%, either one. Worst case scenario, 3% with the maximum charges, they're also gaining money. So this is a very solid plan here. And you can see year 15, I scribbled in here very nicely with paint. You can see that I actually calculated what the actual rate of return is. I want to know not what the company is saying is being returned, but what is actually being returned. And if they earn 7% average, they're actually getting 5.8%. That is a very low cost inside this contract. Even a money manager could charge up to 1%. So you can see that cost here is about as low as it can be, and it's definitely as low as I've seen in any of our insurance contracts. And that's because of the zero premium load. In most cases, you'll see that it's about 1 and 1.5% lower than the credited rate is what you're actually getting returned in the policy. The guaranteed charges only reduce your return by 50 to 100 basis points. That is definitely rare that it only makes that small of a difference. How does this compare to a CD? Well, a CD is taxable. A MEC contract is tax deferred. Okay, and I've got a little chart here where I brought all the scenarios into play to show you exactly how this would stack up. And I took into account any penalties that a MET contract would have if you took out your money prior to age 59 and a half. Let's say you get 20 years into this thing with a 3-year CD at 1.5%, which, like I said, was the best rate I could find right now. Your client reinvests that every 3 years and just keeps pouring money back into this thing. In 20 years, they've turned that $250,000 into $308,000. Okay, not real great. All right, assuming they earn 7% in the life insurance contract, they've got 630. Say they only returned 5%, really conservative here. They've done $150,000 better than they would have done in that CD. And at the same time, you got to remember they've had a death benefit, chronic and critical illness riders. So what does a commission look like this? What are you stand to gain for selling these? Now, North American doesn't change your percentage of your payouts. They have very good commission payouts, but they do reduce your target by 38% for adding that waiver of surrender charges. And they pay 1% on the excess over the target. This is strong. This is better than our other carriers do by far when you add a waiver of surrender charges rider. Okay? So on that male age 50, 250,000 we looked at, you get paid about $5,000, more like an annuity commission. At 70, you get close to 10. So these are probably smaller commissions than you would normally think for getting somebody to put 250 grand into a policy. But my argument would be that you are creating new sales with this product that otherwise you would not have gotten. You're not redirecting money that you would have put somewhere else. You're getting a new sale that otherwise you may not even have thought to ask your client about. Okay? This is a great opportunity for you. So your conversation with your client might go something like this. What if I could give you a tax-deferred return somewhere around 5 to 6%? What if I could give you an immediate death benefit around 2 to 5 times what you give me? I can give you a chronic illness rider to cover your long-term care needs. I can give you a critical illness rider to cover any major medical event that happens to you. I can give you immediate access to 100% of what you put in. Your money is completely liquid. Would you be interested in replacing your CD? All right, it's a pretty simple conversation to have because you're giving them so many benefits, and they're not doing much with their money right now. Okay, so what I would challenge you to do is to take this concept, write down some people that you were thinking about that came to mind as I went through the webinar, write them down, and then commit to calling at least one of them a week and talking to them about this concept. We have started to see sales come in on this concept. If you can do that, I can guarantee that you will start to generate some sales with this. All right. Well, at this time, I would be glad to take any questions. The lines aren't open, but we do have a chat bar. It should be somewhere on your screen there for part of the webinar. Feel free to type in a message, and Dwayne will read it to me, and I would be happy to answer it.
I'll give everybody a minute here.
Okay, no questions, Wayne?
Yeah, don't see any at the moment.
Okay, I'd like to thank everybody for being on the call, and I want to remind you that at the Milner Group, we're here to help. Please, if somebody comes to your mind, or if you just want to see how this works, please give me a call or shoot me an email and give me the scenario, and I will get some illustrations to you and talk you through it. All right, thanks, everybody.